Our next speaker is Rick Rule. He retired as chairman of his Sprott U.S. Holdings and now runs Rule Investing Media, helping investors achieve success. Today, he will speak on Arithmetic of America. Please welcome Rick Rule.
That works. Thank you, Jayant. I want to begin by acknowledging the hard work that Jayant has done around this conference, both today and for the last decade. So please, a big round of applause for Jayant. I think I've been coming since the first Capitalism and Morality, and I've always been impressed with the high intellectual and moral tone of this conference. This discussion that we heard here was a great example of that. I need to say, however, that that's over. We go from philosopher to, I hate to say it, politician, to all those kind of things. We've now descended to pawnbroker. This won't be a discussion so much about narrative or rhetoric. I'll leave you to do that tonight when you're drinking over dinner. This is just about math. Now, I'm not trying to say that some of the math that I give you won't be values laden, because I was the one who assembled the math I'm going to give you. But I want to talk to you about the arithmetic of America. I want to give you the ability to, rather than debate in high, lofty tones, to impose addition, subtraction, multiplication, and division to the social construct of the United States. By the way, I realize I'm in Canada. This is an American-centric debate. I'm doing that because I'm familiar with my numbers, and I'm less familiar with your numbers. I'm not meaning to slate Canada. I just basically try to confine myself to insulting political regimes where I'm a current taxpayer, and I don't have that status here in Canada. So I'll leave it to you to decide, based on the arithmetic, what is narrative and what is reality. I want to begin my talk with 4 quotes. You don't have to remember all of them, but I want you to remember the quotes in context because it will put the math in context. The first quote, I don't know the author of. It goes like this: when your outgo exceeds your income, your upkeep becomes your downfall. You will understand what that quote is about as I go through some of the numbers around the American economy. The second quote is much pithier. It's a Hemingway quote. They asked him how he managed to go broke, making all the money he made from all his books. He says, you go broke a couple of ways. Slowly at first, and then very rapidly. Or that all of a sudden, I'm sorry. That'll be important too. The third quote, because I'm talking about the absolute problems facing the U.S. dollar, not the relative problems, not the problems relative to other fiat currencies, but the absolute problems around the U.S. dollar. And people too often suspect that I'm making an argument for wholesale diversification of the U.S. dollar. This quote comes from a great mentor, Doug Casey. The U.S. dollar is the worst currency in the world with the sole exception of all of the others. And then my final quote, which I hope will be the point of all this, comes from my friend Robert Friedland, who said, the situation is hopeless, but it need not be serious. At the end of the discussion, I'll talk to you about the implications of this arithmetic, not merely for humankind, but also for yourself. So let's get started. I'm going to give you some numbers. And I'm going to talk to you maybe a little bit around some of the numbers about why I think they're important and why you should consider them. But remember, these are numbers. I'm not a Democrat here. I'm not a Republican. I'm not a conservative. I'm not a liberal. I'm not any of those things. I am a lender. I am a taxpayer. I'm not an economist. I'm a credit guy. That's where these numbers come from, okay? And these are American numbers. I'm going to start with this, and some of you might want to write these numbers down because sadly they're cumulative and compounding, like all arithmetic. The first comes from the Internal I'm tempted to say infernal revenue service in the United States. And this is the aggregate private net worth of all Americans, their assets minus their liabilities. That number, according to the IRS, I have no idea if it's true, but that is their business, is $161 trillion. That's our ability to finance our future, our private ability to finance our future. The second is annual private gross income, all sources. This includes corporate, which is $23 trillion. That's what the government lives on. It's what you live on. It's what produces the economic surplus to reinvest, to grow the economy, to pay future debts. $23 trillion. Aggregate personal savings of all sources on an annual basis. Congressional Budget Office, $6.15 trillion. The next one I'm going to editorialize a little bit. Many of you, I think, know the American politician Bernie Sanders, who suggested the cure for all the problems is increasing the taxes on the billionaires. So putting this in context, according to the IRS, the aggregate net worth of all of America's billionaires combined, all the money all the billionaires have, is $6.1 trillion. We'll talk later about Mr. Sanders' arithmetic with the size of this potential piece of plunder. Now we come to some really interesting numbers. These are all pluses that I've given you, you know. Now we're going to start doing some minuses. Aggregate on balance sheet federal government debt. That's how much the U.S. government owes the bondholders. You may remember Mr. Clinton saying it doesn't matter because we owe it to ourselves. Well, it does matter because the spenders owe it to the savers. And there's more spenders than there are savers, which says something about the probability of it getting paid back. Anyway, the aggregate on balance sheet federal government debt is $32.9 trillion. That number's a little high. We'll learn why later. But remember that one. The next number, nobody pays attention to. This is my favorite number of all in this discussion. It's one that I actually watched Maxine turn sick about last year when I quoted it. The net present value of unfunded government obligations. These aren't on-balance sheet liabilities. These aren't things that are owed to bondholders. In fact, if you want a representation of them, look at me. Old folks. Entitlements. Medicare, Medicaid, Social Security, military pensions, federal government pensions. The net present value, not the nominal value, but the discounted net present value of unfunded federal entitlements, not including state and local, federal entitlements in the United States is $120 trillion. This $120 trillion estimate is not from a fat, old, cranky anarcho-capitalist. This number comes from the Congressional Budget Office. And for once, I would concede they're probably better at these things than I am. I have no idea what it is. That's their number, $120 trillion. Let's add a couple of nickels and dimes, or rather subtract a couple of nickels and dimes. The net present value of all unfunded state and local liabilities, federal liabilities aren't enough, $2.3 trillion. To paraphrase somebody, I forget who, a trillion here, a trillion there. Sooner or later, you're talking about real scratch. But let's keep going. Estimated annual accretion of unfunded federal mandates. What does that mean? It means that this $120 trillion doesn't get smaller every year. It gets bigger every year. The annual accretion of unfunded entitlement liabilities facing the United States government, not including state and local governments, is $2 trillion a year. In other words, rather than that 120 getting smaller, it gets bigger by $2 trillion a year. federal on-balance sheet liabilities. That's the deficit. You may notice that in Mr. Trump's big, beautiful budget, he forecasts the biggest deficit in recorded history. Notice, too, well, maybe you don't, and I'm getting away from math, but this guy really pisses me off. Notice, too, that in that budget, the spending is front-loaded and the saving is rear-loaded. I'll leave it to you to decide about the probability of the savings, but I'm editorializing, which I thought I said I wouldn't do. The deficit is budgeted at $2 trillion a year. So just for fun, I'm giving you a preview of the coming attractions. Given the gross federal revenues, that means all the government all the government receives every year, is $5 trillion. Source, Congressional Budget Office. And the deficit itself increases by $2 trillion a year, and the accretion of the net present value of unfunded liabilities increases by $2 trillion a year. And given that the current interest on the government debt is $1 trillion a year, what that suggests is that all of the current income of the United States is consumed by the increase in the deficit, the increase in unfunded liabilities, and the interest on the federal debt, leaving no money left over in an accounting sense for any of the other functions of the United States government. Now, Albert will tell you that's probably a good thing. Let's call the question. They have no money. They can do no harm. I'm going to leave that to you, but I want to leave some of this math with you. So if you total the on-balance sheet liabilities of the U.S. government with the off-balance sheet liabilities of the U.S. government, you come with a really stunning number. That number is $157 trillion. You may remember, I'm sorry to throw all these numbers at you, but this is about arithmetic. You may remember that the first number that I related to you was the aggregate private net worth of all Americans. The private net worth of all Americans is $161 trillion. The aggregate on and off balance sheet liabilities of the U.S. government is $157 trillion. What that suggests is that in any rational accounting of the U.S. federal government, their aggregate net worth is minus $11.5 trillion. This is simple arithmetic. You take what we're worth as private people, and you subtract from that what we contractually owe, and you end up with an $11.5 trillion hole. But it gets worse, of course. Remember that annual private savings, all sources, that is, the money that corporations and individuals manage to steal from the depredation of the government, is $6.15 trillion a year. That number needs to finance any retirement that we might hope to enjoy, given the unlikelihood that $120 trillion will be maintained. And it also has to provide enough money for enough reinvestment in the private sector that future incomes will both sustain us and sustain the deficit. Understanding that the government already consumes 44.9% of GDP. Again, Office of Management and Budget. So let's look at this arithmetic. What we have is 161. What we owe is a very large number. And rather than digging ourselves out of that hole, we dig that hole deeper. And we do it every single year. One policy prescription that we hear, and by the way, I'm not in this favoring Democrats over Republicans or Republicans over Democrats. I'm just talking about the arithmetic. But one of the common suggestions, and I alluded to it earlier, about the way that we might dig ourselves out of this problem would be to make the rich pay their fair share. You hear this a lot. So let's do a little arithmetic around that too, just for fun. According to the Internal Revenue Service, the richest 1% of Americans pay 41% of the income in the capital gains tax. If you include property taxes, the richest 1% pay 52% of property income related taxes in the United States, while enjoying 21% of the income. So if the rich were to pay their fair share, one wonders how the government might afford their rebate. If the rich were actually to pay their fair share, you'd have to cut their taxes in half. And I don't think that that's a very popular, well, it might be a popular outcome. I shouldn't say it would be unpopular. You'll remember too, and I want to go after this number again, that if rather than increasing the taxes on the billionaires, you stole all of their net worth, you took all of their money, the aggregate net worth of American billionaires is $6.1 trillion. To put that in reference, every year, the on-balance sheet liabilities of the U.S. government grow by $2 trillion, and the off-balance sheet liabilities grow by $2 trillion. In other words, if you stole all of the billionaires' money, you didn't increase their taxes, you leveled them, right? You know, Mr. Musk, goodbye. Mr. Gates, goodbye. Oh, and what's the guy from Illinois, the governor, Pritzker? He's a billionaire too. Goodbye. If you took all their money, you'd solve the problem for a year and a half, and you'd still be left with $157 trillion in net liabilities. You starting to see the problem? Now, it gets worse. I mean, I shouldn't laugh about this. I really shouldn't. But it's, you know, it's like laugh or cry. And if I started crying, you'd go to dinner early or something like that. So you have to laugh about it. The prescription for this, well, I don't know that there is a prescription. But one of the things that I guess scares me arithmetically, if I haven't done enough to scare you already, are other assumptions in our economy, as savers. Because where all of this is going, where all of this arithmetic is going from my point of view, and the way that I make my final point about the situation is hopeless, but for you it need not be serious, is if you understand the implications of these numbers, while you can't do anything to derail this government train, you can do something yourself in terms of getting off the train. That's where this is going. And there's a few things that you understand. When most people think about inflation, and we heard it referred to today in the room, they refer to something called the CPI, the Consumer Price Index. If you believe in the Consumer Price Index, you think that inflation is actually fairly modest. 2.6, 2.7 a year. I want you to use your common sense. First of all, most people don't realize this, the CPI doesn't include tax. Think about a cost of living that doesn't include tax, where government expenditures are 44.6% of GDP. I suspect if I didn't have to pay the tax, I'd bitch a little less about the index. But the truth is that trying to construct a cost of living index that doesn't include the largest component of household expenses is silly. And then, of course, the index is hedonistically adjusted, which is to say, they don't pay attention to how much I paid for the cell phone. What they try to do is figure out what the utility generated by the cell phone is compared to the utility generated by a cell phone 10 years ago. And they suggest that despite the fact that it costs more, it does more. And as a consequence of that, the technology is lower, not statistically, but rather hedonistically. But I would ask you to apply a common sense test too. And you're not going to get the right number, by the way. You won't. It's okay. Their numbers aren't any good either. Think about the basket of goods and services that you consumed to run your family. Let's say in 2020. And think about the price of that basket of goods and services today. Do you think that your grocery prices have gone up by 2.5% a year? I mean, we're doing black church now. This is call and response, okay? Do you think the price of gasoline is up by 2.5% compounded? How about tax? How about rent? How about in the United States, health insurance? The idea that my cost of living, that the basket of goods and services that Bonnie and I buy, and by the way, we're old and cheap. We don't buy much. But the idea that the basket of goods and services that run our whole household have increased by 2.5% compounded is silly. It's really, 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 truly silly. I have done sort of a back of the envelope calculation using a couple of segregated price indexes. And it seems to me that the basket of goods and services that Bonnie and I consume, the price rises of those goods and services in the period 2020 to 2025 suggests that the value of our savings has been decreasing by about 7.5 or 8% a year. And this is some more bad math for those of you who are old, worse math for those of you who are young. They will index your benefits, which is to say your federal pension, your military pension, your Social Security, by the CPI or by a percentage of the CPI. In other words, they promise through entitlements that they will keep pace with inflation by giving you 80% of the increase of the CPI, while at the same time allowing enough deterioration in the value of the US dollar that the basket of goods and services that you consume rises by 8% a year. Everybody understand the perniciousness of that equation? It's important that when people plan for their future, when they think about private pensions, when they think about public pensions, that they understand something about what Mike Maloney calls the CP lie, or the CPI. The other place it affects you is as a saver. And it really affects you as a saver. You need to think through this. If you are an American person, a saver, and you buy the world's benchmark savings instrument, that's the U.S. 10-year Treasury. That's, for those of you in the securities business, you know. For those of you who don't know, that's the instrument that every other investment in the world is priced off of. The U.S. 10-year is the benchmark. If you believe the CPI and you're getting paid 4.5% on your 10-year, and you believe that your money is deteriorating at 2.5, you're enjoying a 2% positive yield. In fact, people talk about positive real interest rates like it's a good thing. In order for you to feel good about getting 4.5, you have to believe 2.5. If you believe, like I do, that the purchasing power of your savings is declining at 7.5% a year, while you're getting paid 4.5% on your savings, what that suggests is a government-guaranteed loss of 3% a year compounded for 10 years, which is to say, if you give the government $100,000 today, they give you back $60,000 worth of purchasing power in 10 years. This is, by the way, one of the first government guarantees in my life that I absolutely believe. I absolutely believe that if I give them money now, they will reduce my purchasing power by 3% compounded for as long as I leave it with them. Aside from being funny, though, this is the sort of arithmetic that you, particularly younger people, need to begin to deal with this now. We've been tricked is the wrong word. We've allowed ourselves, as a consequence of 40 years of benign economic climate, 1982 to 2022, to believe it's all going to work out. Nominal interest rates fell, real interest rates fell. In the period 1982 to 1992, while the U.S. government didn't shrink, It grew much less rapidly, and the economy grew rapidly. And people tend to believe that past is prologue, particularly when the past is good. If you allow yourselves to believe that the big thinkers have this under control, that Washington has abolished math, that your outgo can exceed your income, I would suspect that you're going to be in for a more difficult time in the future than you have been in the past. And we're going to talk some about that too. What numbers did I forget? Oh, I know. If there's some real sharp pencils in the crowd, you will note that I forgot to note one of the positives, which is to say the federal government holdings of Treasury securities, this $37 trillion that's out, is 4.6. So if you want to, you can take that $37 trillion in debt and you can reduce it by 4.6, because 4.6 trillion we actually do owe to ourselves. Now, that comes about because the federal government sometimes holds treasury auctions and they can't sell all the treasuries. Well, that's kind of problematic. You know, if you need $1 trillion and you get $700 billion in, you're, $300 billion short. What you have to do is you have to, you and I, if we did it, it would be called counterfeiting. They call it printing. Suffice it to say, they have counterfeited $4.6 trillion. They have written these bonds. They've done some keystrokes. They've switched the keystrokes and they've imported the bonds. So that $37 trillion isn't a net number. That $37 trillion needs to be reduced by counterfeiting, which is $4.6 trillion a year. Where is all this going? Well, it's going a few places. For people my age, and I know some of the room is my age, there's a few things that you need to realize. One. No, do I want to go there? No, I want to go somewhere else first. What's the likely way out of this? Just out of curiosity. Let's assume that you had lent some money to somebody, and it turns out that when you look at their income statement isn't sufficient to service their debt or to run their business. And then you look at their balance sheet and you see that in that bottom left-hand number, rather than having equity, they have a negative net worth. As a creditor, what do? Do you lend them more money? Do you try to get back what you have? What do? It's a very, very, very difficult place. My suggestion is that if you owe more than you have, and if your expenses are higher than your income, that the inevitable outcome is a default. Maxine talked about one form of default, and he talked about one form of solution. The easiest default would be a real one. We could, we have the technology. We can look to Argentina. You say to the world's creditors, too bad, so sad, out of money, strong letter to follow. You could do that. You could say to the old folks like me, listen, Rick, you're too fucking fat already, okay? I mean, you're not getting your Social Security, you're not getting your Medicare, you're not getting your Medicaid. We could tell the truth. But that's not in the American political tradition. We don't do that. The way that I see out of this is that we're going to have a dishonest default. This is a proud American political tradition. We heard earlier today the discussion of the decade of the 70s. Let me quantify it for you since I like math so much. According to the Office of Management and Budget, that was the predecessor to the Congressional Budget Office, in the period 1970 to 1980, the U.S. dollar, these are official statistics, by the way, again, not some fat old libertarian, these are official statistics, right or wrong. The Office of Management and Budget suggested that the purchasing power of the U.S. dollar in the period 1970 to 1980 declined by 75%, which is to say it took $4,080 to buy $1,000 worth of 1970s goods or services. I believe personally because of the list of statistics that I gave you just now that passed as prologue. I personally believe in the next 10 years that the purchasing power of the US dollar declines by 75% again. That has some interesting implications, but it also suggests a solution. In the period, I forget the dates now, I'm sorry. Let's just say at the beginning of the 1970s, the on-balance sheet liabilities of the U.S. government relative to GDP were hovering around 90%, 100%, somewhere like that. By 1982, because of high interest rates, all that kind of thing, and a reduction in the growth of the U.S. government, on-balance sheet liabilities of the U.S. government relative to government debt had declined to 32%. We're back in the place now in 2025 where the on-balance sheet liabilities of the U.S. government are at $37 trillion, while GDP is at $30 trillion, which means that on-balance sheet liabilities of the U.S. government are 120% of GDP relative to, in 1982, being 32% of GDP. You see, it isn't just the size of the problem. It's the size of the problem relative to the size of the solution. I personally believe that the way you politically handle the problem of $120 trillion in entitlement obligations and $37 trillion worth of debt relative to the ability of our society to generate enough wealth to do it is, in a way, elegant and pretty simple. You reduce the purchasing power of the currency that you have the debt in, which is to say, over 10 years, you reduce that 120 trillion nominal value of obligation down to some number like 30 or $35 trillion, while not indexing taxes to inflation. You do a bunch of other stuff too. And we just have to get our heads around this. Whether we like it or not, it's going to happen. The assumptions around our entitlements, but particularly Social Security, are unsustainable. Many people don't know, but when Social Security was instituted, it provided you protection at poverty levels from age 65 on for the rest of your life. The average life expectancy of an American male at that point in time was 66 years. So they promised subsistence to you at poverty level for 1 year. There were 4 workers for every beneficiary, which is to say that the ability of young people to sustain old people was higher then. Those numbers have been turned on their ear, and the average life expectancy of an American male is now approaching 82 years. They're going to have to raise the eligibility level. They're just going to have to raise it. It's going to be hugely, hugely unpopular. When I go through this arithmetic on social media, people say, this is impossible. I've paid into this my whole life. I deserve it. All this kind of stuff. That's all true. It doesn't matter. It's all true. I'd say, I realize that you've paid in your whole life. You realize that they have taken the Social Security surplus for 70 years and invested in U.S. 30-year treasuries. The money is gone. Okay. It doesn't matter that you deserve it. The money is gone. So it's important to understand that in addition to devaluing the U.S. dollar by 75%, they're going to have to raise the eligibility level. They are over time going to have to reduce other transfers, which is to say the disability clauses, the idea that, as an example, addicted dependents can get Social Security. I mean, that stuff's going to have to go. They are going to say to old rich guys like me, the idea that you only pay Social Security tax on the first $160,000 worth of your income is going to go away. We're going to tax you on all of it. And then they're going to do something really lousy from my point of view. They're going to means test benefits, which is to say you have to pay tax on your whole income. But if you make more than $250,000 a year, you don't get the benefit. In other words, it's not going to be an insurance program. It's going to be a straight transfer. And all that's a given. I mean, it has to happen. There's no way out. People look at Social Security and they look at it in isolation. They say, well, Social Security is only What a wonderful phrase. Social Security is only a $32 trillion program. Problem. That's all we have to fix. $32 trillion. Only $32 trillion program. They take it in isolation. They don't look at Social Security as being part of a problem that must be linked to Medicare, Medicaid, federal pensions, and military pensions. The idea, I guess, that you can serve one set of constituencies without serving all of the other constituencies kisses it and makes it all better. But that's not true. So this is all going to happen. The point of all of this is that the future is going to be less benign than the past has been. And you need to prepare yourself for this. If you are thinking that your pension is sufficient to sustain you in your declining years, that's wrong. It's just plain wrong. If I'm right, and you heard my arithmetic, I would invite somebody who's good at arithmetic to show me where I'm wrong. If I'm right about this, it suggests that the U.S. dollar will indeed suffer a 75% decline in purchasing power over 10 years. If your pension isn't going to enjoy a fourfold increase over 10 years, you're going to get further and further and further behind. If you believe that your private savings are sufficient, think about your private savings in the context between the delta between your pension paying you 25% of what it does today and your likely living expenses, which I would argue are increasing. Think back to the decade of the 70s, too, about what worked and what didn't work. Some of you, well, most of you are too young to remember this, but some of you will remember it, perhaps not fondly. At the beginning of the decade, the U.S. 30-year Treasury paid about 4.7, 4.8, 4.9%. At the end of the decade, the U.S. Treasury, the 30-year Treasury, the long Treasury, paid almost 15%. What that means is that if at the beginning of the decade you owned a long Treasury, a long bond, a 30-year bond, allegedly the most riskless asset in the world, your principal value declined by 65%. Your principal value, owning allegedly the safest asset in the world, fell by 65%. If we come into a period where the deterioration in the purchasing power of the U.S. dollar declines the way I think it will, please, please, please avoid long bonds. Please avoid any duration more than 5 years. By the way, a floating rate mortgage is the backside of a long bond. So if you have the ability in the United States to get a fixed mortgage, by all means do it. Don't get yourself in a position where saving yourself 150 basis points today exposes you to 1,000 basis point increase over time. The other thing that we learned in the decade of the 70s is that in terms of the equities markets, there's no shelter in the market as a whole. Some of you might remember the decade of the 60s, the Nifty 50. The concentration on high growth stocks and the fact that these stocks went to unheralded valuations. People forget that in the period 1968 to 1982, we had a bear market in stocks where over 14 years, the price of the equities markets represented by the index fell by 10%. There was no shelter in the equity markets as a whole. It's important for you to understand, though, the equity markets themselves aren't a monolith. They aren't a subject. Equity markets are a facility for buying and selling fractional ownerships of businesses. People don't think about that anymore. They buy the market as a whole. They buy the S&P 500, they buy the QQQ, they buy whatever they buy. In the period 1968 to 1982, where the equities markets were flat to down for 14 years, Buffett, by buying companies with pricing power, and by not losing money, by simply buying good balance sheet, managed a 22% compound internal rate of return for 14 years, while the market was sideways. There's a lesson there, too. You can get through this. It's just that you're gonna have to think. I guess the bottom line here, you'll recall at the end I said the situation is hopeless, but it need not be serious. Don't be a government. Don't live beyond your means. Don't blow up your balance sheet. Don't assume that what worked for you over the last 40 years is going to work for you over the next 10 years. I have a bias because of what I do. I note that in the period of the 1970s, when the purchasing power of the US dollar fell by 75%, that the gold price increased 30-fold. I'm not going to stand here and say over the next 10 years the price of gold is going to go up 30-fold. Hell, it's already up 12-fold since the year 2000. But I would suggest that the price of gold is more likely than not to mirror the decline in the purchasing power of the US dollar. Don't go overweight gold, by the way. I could easily be wrong. It's important to note, however, that gold's market share in the U.S. market is 0.5%. More math. Thank you. The total value of savings and investment assets in the United States is such that less than 0.5% of it is constituted in physical precious metals. If you look back over the last 40 years, the same number has been 2%. A mere reversion to mean increases demand for precious metals fourfold. But this isn't really about precious metals. Giant tells me responsibly that my arithmetic has made you all sick enough. That really wasn't my point, but what I wanted to do was explain the problem in front of those of you who are Americans. Frankly, it's going to be worse for the Canadians. In an arithmetic sense. I'll leave the solutions, I'll leave the rhetoric, I'll leave the narrative to you all. Giant, thank you for the opportunity. Ladies and gentlemen, thank you for your attention.